welcome to the Money Show, your one-stop destination for all your personal finance queries. I'm Kavita Thaplian and we have lined up our pack show for you today where we'll be talking about various aspects of your financial portfolio, and today we'll be focusing on your mid-cap and small-cap allocation, and we will also throw up on the counter to get your mutual fund portfolio queries answered. Just in case you're watching the show live right now and want to send across your questions, you can do that via WhatsApp number, which is 8657974571. You can also email us your questions on themoneyshow@etnow.tv. So a great lineup of content. Alright, so let's just talk about your allocation in mid-cap and small-cap and what should be your strategy as far as investing in these market-cap stocks and your mutual funds. How should you reallocate and rebalance your portfolio? Let's figure all this out. Today I have with me Kaustubh Belapurkar, Director Fund Research, Morningstar Investment Advisers India. Kaustubh, good evening and welcome to the show. So Kaustubh, all stories are around mid-cap and small-cap and the kind of froth and bubble coming up. We see EMCs conducting a stress test, which was also happening early in the industry, but then for the first time made public as per regulators' instruction, and we'll be seeing more stress tests coming up every 15th of every month. But now the entire thing comes around rebalancing your portfolio and reallocating your profits, that you have made from mid-cap and small-cap. But also, the conversation that's also going around is on having realistic expectations. Now, the situation over here is we are also addressing or talking to investors who maybe do not understand what is the definition of realistic return expectation, because all they have seen is one kind of market, a market that's moving only in one direction. So right now, in the current scenario, when we talk about realistic expectation in mid-cap and small-cap, how would you like to define it? How would you like to explain it to those investors who's maybe for the first time witnessing some kind of volatility?
Sure. Firstly, Kavita, thank you for having me on the show. And I think a very, very important time to be having this conversation. Obviously, there have been so much news flowing about, the stress tests and we've seen the kind of movement we've seen in the small and mid cap space for the past couple of years. And I think more importantly, what we've seen is increasing in investor interest in mutual funds, and especially in this space, right? So I think it's very important to kind of think about how are investors reacting and what should they really be looking at. So firstly, like I said, two things have happened. We've seen the sharp run up in small and mid caps, especially on the small caps, in 2023. And in fact, since 2020, they've been, after the COVID correction, and then after that, the markets have run up. I think small and mid caps have been quite buoyant, right? But if we just break it down, even in this time period, what you would see is that 2020 was a good year, 2021 was a good year, 2023 was a great year in terms of returns, but 2022 was actually flat to negative for these counters, right? If I take it a little bit back in time and I look at, the years of 17, 18. So 17 again was a great year for small and mid caps. They rallied anywhere between 50 to 60%. But when you look at the years of 18 and 19, you had periods where small caps corrected anywhere between 15 to 20%. And into 19, they continue to correct, albeit slightly lesser, but maybe 5-10%, right? So I think that is par for the course when it comes to mid and small cap stocks, especially in the small cap space. We talk about volatility, that is very much observable when you try to extend the time period of your investment horizon. It's going to come and go, right? So you're going to have great periods. At the same time, you're going to have flat to negative periods. That's really a function of the market, right? You're right. I think investors have obviously who've seen the recent returns in past have been quite excited about expecting that, look, if in 2023, small caps have given anywhere between 40-50%, I can expect and extrapolate this will continue year on year on. Clearly, I think the important thing to think about is that is not the case, and history has taught us this, over many, many decades, that, these cycles and, some of these return periods that are highlighted, it'll continue to play out in that case, right? So when we think about expecting or putting realistic expectations, so we think, yes, small and mid caps are great long-term wealth creators. If you have a long investment horizon, you want to take on some additional risk on your portfolio, you can allocate. But I think as an investor, you need to keep a few things in mind. One is that have an adequate time horizon. And when we say adequate, given where small and mid caps are in terms of valuations today, I would say anything less than 7 years, probably, you would want to go very, very careful on the small and mid cap side, especially on small caps, ideally look at least 10 years, right? Because you'll have cycles where, like I said, could be negative or flat, and then you'll have these great years coming in over periods of time. So A, you need to be invested, but be rationally invested. And secondly, have patience. So if you've come in more recently, looking at the past returns, you've seen the volatility, albeit not that heightened in the recent times. But there could be periods where these counters do correct. Stay patient. As long as you're not over allocated to these counters, and then ride out the wave, over the long period of time. So I think that is about setting realistic expectations, not just in terms of returns, but also in terms of the investment time horizon that you need to think about when you invest in these sort of stocks or funds.
Kaustubh, let's also talk about the kind of correction we've seen so far. Obviously, as compared to the run-up, the correction is not that heavy or that deep yet. But then, going ahead, do you think that there are chances of the kind of gains that we've seen completely wiped out? Well, no one can actually predict that. But looking at the correction right now, where do you think the mid-cap and small-cap would actually come down to a very realistic level?
Honestly, Kavita, I think it's very hard to pin down that, can any correction happen or, at what quantum. But I think, some of these historical examples that I was quoting was, to exactly that point that, and I'll just reiterate some of that messaging, right? So 2017, for instance, where we had this great bull run in small and mid caps, and if memory serves me right, they were up 50 odd percent, similarly what we've seen in 23. And then for 2 straight years, the small cap index and funds were down anywhere between 20% in 2018 and about 5 to 10% in 2019, right? So we have seen periods of this when things become a little excessive or overvalued. There are chances that there can be correction. Obviously, we know that since then, they have obviously made up and more of that. But if investors either came in with unrealistic expectations looking at 2017 returns or similarly in 23, and then saw 2 years of negative and reasonably significant negative returns, maybe some of them, just exited their investments at a loss, right? I think that's what we want to guard against. Because say an investor came with only 3-4 years investment horizon, maybe not the right asset class to come into, right? So I think that's what investors need to be wary of. Having a elongated time horizon, the patience to hold, and don't expect over the moon returns, because over a market cycle, this will normalize. That's really the law of averages that, plays up in markets and other parts of the economy. So I think that's important to keep in mind when you think about investing in small and mid caps. So yeah, I mean, no one can honestly say that, it's going to correct an X% in what period of time, but history teaches us a lot of lessons, and I think that's important takeaway when we think about investing in equities in general, and especially so in small and mid caps.
Sure. Kaustubh, I also want you to help our viewers understand slightly, on the PE aspect of mid-cap and small-cap stocks that we are talking about, which have really reached to very unrealistic levels, almost above 40 kind of PEs that we are seeing in small-cap, and, the same kind of thing in the mid-caps also. Realistically, how much do you think fund managers are also, looking at these kind of PEs, or how much do you think they are trying to get rid of the companies with these kind of PE levels, especially in a case where there is no rise in the earning?
Yeah, sure. So I think, obviously the PE typically is always looked at a broad level, right? And when we talk about also from a fund manager's perspective, they will obviously try to, I mean, there could be different styles each fund manager would run. There'd be fund managers who would purely be looking at high growing companies, and they don't mind paying additional valuation. So when you adjust it for growth, when you think about what we call the PEG ratio, it actually looks a lot more reasonable, given that it's a high growth company. So it might be excessively valued in that sense. But at the same time, this is a broader P, right? You can have instances of companies that are significantly cheaper, where managers can still find a reasonable amount of value, where, either there could be a turnaround or they're expecting some sort of a trigger to come in, for that stock. So yes, there will be pockets of opportunity, but yes, as a general sense, it is on the, the more overvalued zone, as compared to, the broader market or large caps. And so when you talk to any asset allocator or fund manager, they would typically, think about that if a particular sub asset class is slightly more expensive, maybe I will book some profits. I might go slightly underweight in that asset class, and, maybe reallocate to, if I want to stay in equities, maybe to a large cap, which are relatively cheaper. Again, they're also slightly in the overvalued zone, but not as overvalued as, sort of smaller and mid caps.
Kaustubh, a lot of discussion around having liquid and illiquid stock in small cap portfolio is also going around. Okay, could you also demystify and maybe decode this aspect of fund managers' strategies that we are seeing coming up in small cap, especially after the stress test?
Sure, sure. And I think that's, it's a very interesting and important conversation again, in terms of liquidity. And I think, like you rightly said at the start, and we've also had these conversations with many, many fund managers that we speak to for many, many years, that, they've been looking at liquidity as, and, that's tool, they assess, obviously, their boards and their management also, keeps an eye on that, because you don't want to have very, very sort of illiquid portfolios that you cannot redeem, if if you have to sell off in case of redemptions, right? So I think in terms of the overall numbers that are being put out, in terms of the stress test, I think as an investor we don't need to really read too much into it, and purely because unless there's a fund which is an absolute outlier, right, which I don't think we've seen from the perspective of the numbers that have been shared. There's no one fund that's completely illiquid as, compared to, being 10x more illiquid than the others. That's not really been the case, right? And I think, most of the managers on the street have been looking at it any which ways. And we've seen instances of fund managers actually shutting the fund for new subscriptions or slowing down subscriptions or only allowing SIPs, to ensure that, there's not too much money coming in at one go into the fund for exactly that reason in terms of managing the liquidity. The other thing that a lot of people don't necessarily look at, and I think that's important to think about, is also capacity, right? So while the liquidity might look okay, is the capacity of the fund actually good enough or not? And when we talk about capacity, which means that, if you say a 5,000 crore fund, can you take on another 5,000 crores of assets and manage the strategy exactly the way it was being managed for those initial 5,000 crores, right? Because maybe you're a very, very valuation conscious manager. Can you find enough stock ideas for the, if you keep getting additional money? So I think that's the very important conversation that obviously managers are also looking at in terms of capacity. Again, I think that's a, tracker that's probably best left for fund selectors and, obviously the risk committees and the board trustees to look at. But I think what all of this conversation has done is just helped investors, because we've seen so much excitement about small and mid caps in general. I mean, if you look at 2023 flows, small caps received some 40 odd thousand crores, the largest category in terms of flows. Mid cap was third, and I think thematic funds were second. So a lot of money is being chasing past returns, right? So I think it's brought that conversation forward that, look, things have probably run ahead a little bit of time. So maybe investors are also kind of chasing returns, over allocating, and it's making them aware that, you need to think about your portfolio, your asset allocation, rather than purely chasing returns, which is, I think, a good exercise to do at, at this point in time, especially just given the significant run up in the markets.
All right, so it's now time to reallocate and rebalance your portfolio. And do you also suggest moving slightly more towards large cap?
Yes, so I think two things, Kavita. One is clearly, I think, just looking at, the average investor on the street, looking at what the flows numbers suggest, and, a lot of the queries that, in fact, you also get from your viewers on the show, it seems to suggest to us that a lot of money has, or investors have over allocated small and mid caps, probably not understanding the risk, probably not having the right time horizon. And this is a great time to, book some profits or course correct, right? Because, if you've made a reasonable amount of return in your small and mid cap allocations we invested even 2-3 years ago, now's a good time to reallocate some of that money to more large cap equities, or just course correct simply because, obviously the markets are still at elevated levels. You want to just take some money and come back to where your, allocation, what your risk return objectives suggest. So I think that's a very important conversation to have. Clearly, like I said earlier, if you don't have at least a 7-year horizon, perhaps you're better off staying in large and flexi cap funds. You want to significantly bring down your small and mid cap exposure. I think that's the other thing to kind of, consider when you're reviewing your portfolio.
This is a discussion that can just go on with a lot of more aspects to it, but then we really have to move on to one very important chunk, which is on tax saving. As the end of the financial year approaches, it becomes essential to make well-informed decisions about tax saving investments before the March 31st deadline. Anandati Wealth's Deputy CEO Feroz Aziz talks about how to save tax on mutual funds. Listen in.
I think it's very important to understand that mutual fund is a very tax efficient platform. But over the years, over more than 50 years of mutual fund industry, there are so many options which one has. Which one is the most tax efficient for you may not be something very easy to comprehend. As a thumb rule, if you're looking at investing in mutual funds, equity mutual funds should be in growth option and not dividend option. Earlier, dividends were tax-free in the hands of the investor, now they are not. So if you have any mutual fund portfolio, especially in the equity side, which is dividend option, move that to growth option because dividends will add to your taxable income.